Hi, my name is Borcherdt, and today I'm going to talk to you about the multi-step income statement. The income statement is one of the 4 key financial statements taught to us in Accounting for Business Decisions A, and they provide creditors, investors, or any other interested party a public document that details the financial position of a business. There are 6 key components to the income statement: revenue, cost of goods sold, gross profit, expenses, other expenses, and your net profit. So we'll dive right into it and start with revenue. And revenue equals sales multiplied by the price. Now the sale can equal any service or good provided, and the price can be a set price or an hourly rate. Pretty straightforward there. Revenue also includes any sales discounts. Now moving to cost of goods sold. A bit more complicated, a couple of ways to calculate it. Most common is beginning inventory plus cost of goods manufactured minus your inventory. Now, pretty logical. How much you start with, how much you add to that, minus how much you end with, tells you how much you've distributed and how much that's cost. Now, moving to gross profit, encompasses the 2 that we've just mentioned: revenue minus cost of goods sold. Gross profit equals how much money is flowing into your business as a result of sales, your revenue, minus how much money is flowing out of your business as a result of sales, cost of goods sold. Now we see an example here. We have our revenue, our cost of goods sold, which includes our beginning inventory and our ending inventory. Everything in here is your cost of goods manufactured. And if you have a look at these numbers, it all adds up to the equation I have just provided for gross profit. Now moving on, we have selling and general administrative expenses. They are pretty general. They're calculated through your T accounts and your journal entries and move into the financial statements, so not too much to worry about there. It's not calculated within the income statement. What is partially is your other expenses, and they include your interest revenue, how much money you earn on loans you give out, your interest expense, which is any money you owe as a result of your loan, and your tax, which, unless otherwise stated, equals 30%. And if we bring all these components together, we get our net profit, which equals our gross profit minus any expenses, to calculate how much money you end up with in the end. Now we come back to our example, and you can see here our gross profit minus all of our expenses is going to give us net profit. Thank you for listening. I hope you enjoyed.